non-admitted ENS was kind of like a bad word in our industry. About 10 years ago, it meant that you were a
It was a
bad
dirty
risk
word. It
because
wasn't even a bad word. It was a dirty word. All right, welcome to the Risk Rundown episode about admitted and not admitted with my co-host Tyler Banks. Thanks, Tyler, for joining.
you're welcome, Julie. And, this podcast is so important that whether in sickness or in health, Julie, we are here for you. We are here to inform you what's going on in the insurance industry. Julie's a little bit under the weather, but just like the post office, she delivers in rain, sleek, or snow. She is here for you guys.
But I think this is a good topic. This is something that you and I are talking about all the time. And that topic is admitted, non-admitted, and self-insuring, right?
And if I just look 5 years ago, there was admitted opportunities up and down the coast in California without any issue. Now we're in 2026, Julie. There's no such thing as an admitted product for a $20 million home in California. It's just not out there. Everything over $20 million that we are seeing falls into the non-admitted market because it just gives them flexibility with the rate, and it gives them flexibility with the contract. But it's just not available in California for anything, not even coastal property, for anything over $20 million. Vast majority of that is going into the non-admitted market.
Can you kind of explain a little bit about what
Sure.
the differences are between the admitted product and a not admitted? Not necessarily the coverages, but why, how they're
Yeah.
structured, right?
Great question. And again, non-admitted ENS was kind of like a bad word in our industry. About 10 years ago, it meant that you were a
It was a
bad
dirty
risk
word. It
because
wasn't even a bad word. It was a dirty word.
no one wanted to, like, if you
Yeah.
were with an ENS non-admitted product, that means that you were really not insurable, right? Something had
Yep.
happened, either a profile or there's something, inherently wrong with your property.
Claims.
Yeah, exactly. So an admitted program, in a basic sense, means that the department, you will file a rate and a product with the Department of Insurance, whatever state that you're in. And the state of California, the state of Virginia, wherever you happen to live, will say, okay, you can sell a product at that rate, to whoever comes to you. Everything is strictly managed by their Department of Insurances on what you could charge per thousand in a particular geography for your product. And non-admitted, in a sense, it's like you are circumventing, that appeal process to increase, the rate on a policy. And you're saying, I am coming up with my own rate guidelines for something that I feel is appropriate for your geography and for my profile. And you are going to charge a rate accordingly. So because you're not going through the Department of Insurance, there's a lot more flexibility with rate increases. We talk a lot about manuscript. You're manuscripting a lot of these forms. A lot of times the carrier or the broker needs to charge you a little bit of a fee for that non-admitted product. But we're in a situation now that non-admitted is commonplace if you live in catastrophic prone areas like a Florida, like a California, even if you're in Texas with the convective storms and some of the flooding that they've had.
Yeah, I mean, and let me tag on to what you said real quick too, is the admitted product, it's all regulated. It's guaranteed, the funds are guaranteed, right? Where the non-admitted, it's kind of more of a, like you said, a manuscript policy. Like, for example, a non-admitted policy in Florida, let's say, they can have different coverage limits on wind and hail or hurricane. That's why it's so important to be able to have a knowledgeable insurance agent to work on your behalf, to be able to work and talk with these insurers to talk about what type of coverages our clients really want to expose themselves to, right? And kind of getting into the self-insurance realm, what kind of high deductibles are our clients willing to take?
But I'd also like to maybe kind of dive in a little bit, Julie, around, when we talk about, again, the non-admitted policy, we talk about, manuscripting some of these things. More clients are choosing to self-insure than ever before. But that can take on numerous, forms. When you're self-insuring, it could be on the bottom end through a deductible. It could be on the top end by putting something, again, on an agreed value versus a
Or a
full value
cap?
replacement cost, a cap. Or again, you can choose not to insure the item itself. Can you just talk about some of the things that you are seeing on the non-admitted side that's more creative today than what we just had a few years ago?
Yeah, I mean, one of the main things now, especially for the people that have multiple properties and multiple homes, is really blanketing a policy, right? So instead of insuring just one policy insuring one house, to be able to actually streamline that process and have one policy that includes a blanket limit for all locations, it is really helpful for that client, right? There's also ways of including sublimits, adding sublimits into that policy, if it be for earthquake, if it be for flood, if it be for, putting a cap on wildfire. Like you have a $20 million home, but you're going to cap out the wildfire exposure and the wildfire coverage up to 10 million, right? Normal policies, maybe you could get maybe $100,000 deductible and that's all you could get. That's the max that admitted policy will be able to offer to you. But a non-admitted product, it can be $1 million deductible on a whole blanket
Hmm.
policy, right? So there's different ways to look at it. To your point, I'd love to get your thoughts on this. There's a fine line that you can actually integrate the not admitted and the admitted products,
Hmm.
right? So you can have an admitted property or policy, maybe a not admitted layer up on top.
Absolutely. Sometimes you can get a basic homeowner's policy, right, that covers, some of your basic perils. And then you can get a policy that sits on top of that that gives you additional coverage and additional limits on your home. So this is actually pretty common on the commercial side, right? So if let's say
Yeah.
you have $100 million high-rise building, rarely do you see one carrier insuring that entire risk, right? You're starting to see layered approach when it comes to these types of risks. And it's interesting because we're also starting to see a direct correlation with the exact risk. So if you're in a severe wildfire zone, you're going to see a higher wildfire deductible, right? I think another thing, Julie, to kind of point out is that, when we had the catastrophe out here, again, just a little bit over a year ago here in the Pacific Palisades, um, a lot of clients were not insured to the actual replacement cost of their home, right? So unfortunately, a lot of these clients that went to the direct market, right? I'm not going to name any names, but the direct markets mean that you're calling a certain insurance carrier and they're giving you a policy. They are not going out and inspecting the home to give you an accurate depiction of what it would cost to replace your home. So we feel it's really important to do inspections regularly, right? So to make sure that you are constantly up to value in and everyone thinks that they know what it's cost to replace their home. I'm sorry, you don't know what the cost is if you are in a catastrophe.
But to kind of loop that into a not admitted, it's important for people to understand those valuations if they are going to self-insure, right? Or if they're going to cap out that policy. If you think that if your home is $10 million, but really it's 20, and you make decisions on a $10 million exposure versus a $20 million exposure, you're not making the same decisions. That's why it's really important to be able to have, even if you aren't insuring it to full replacement cost, it's important to know what that replacement cost is. So you are well educated about making those decisions about what you're willing to self-insure.
Yeah.
So I think to kind of like bring this full circle, I think it's really tempting for people to say, oh, I'll self-insure for those people that are of significant wealth. And I think it's really tempting for them to say, oh, I'll just self-insure that. I don't want to spend the premium on it. It can be very tempting, but it's also very, very risky. And, when the rubber hits the road and there's a claim, no one is thinking in their right mind. They just aren't, right? You need to make those decisions prior to a claim and have a full conversation about what's going to happen in the event that there is a claim and how the policy is going to respond and what they are responsible for versus what the insurance company is responsible for.
Julie, the joke in our industry is, when do people buy flood insurance and earthquake insurance? Right after a flood and right after an earthquake. We get inundated with phone calls. I need to look at
Yep.
my insurance, my earthquake policy. I need to look at my flooding policy. I don't know if I have enough flood. So don't be that person that is reactive, to market
Yep.
and weather conditions. We can't control the weather. the only thing we can do is protect against it, right? But I still don't think that you necessarily, if you've got significant means, you don't necessarily have to insure everything to value, right? Let's do some analytical discussions around what your risk tolerance is, what the market will bear. And I think we can find a solution for most clients that would be reasonable.
It's definitely a balancing act, right? The key is to balance risk and appetite and all that different kind of stuff. So, as we many times do, we have kind of like a rapid fire thing between the two of us.
All right, Julie, here's one for you. A client assumes that admitted products are always cheaper. What's the truth behind that?
Not true. Because the insurers have built in coverages into that contract that they have to price for. And so they have to gain the premiums on that. Where a not admitted product and policy, they can tailor what they want to exclude and what they want to include. And if there's high risk exposure on a certain property that they don't want to include, they don't need a price for that. So sometimes a not admitted feature is less expensive, but the coverages are definitely not the same. We're not comparing apples to apples. One more for you, Tyler. A client wants to self-insure wildfire risk. What's the danger in that? What are the pros and cons for that?
You know, Julie, it's such a tricky question because if you live in a wildfire area, to be quite honest, premiums are extremely high. So people are always looking at, do I insure? Do I not? Do I self-insure? It's funny because I'm now, from my view, I'm looking over Hollywood Hills, which has burned, several times over the last couple of years. I remember having a conversation with a client who had a home on the beach. And they said, why do I need fire insurance? I have the Pacific Ocean surrounding me, right? How could my home, burn? And then the Pacific Palisades happened. And all
Yep.
those homes all the way down to the beach actually burned. So I do think that you can self-insure a portion through a wildfire deductible or maybe even something on an agreed value basis. So you can get creative with self-insuring. But, we highly recommend if you live anywhere near a wildfire zone, self-insuring wildfire is not something that is recommended highly in our industry.
It's a valid concern.
So here's one for you. So you have a guest who is at your home for, let's say, a little get together, a party. They slip and fall and they injure themselves. How does liability play out if you're self-insured?
So this is my take on things. If you're self-insuring liability, it's first dollar paid out no matter what, right? If you're self-insuring liability, that is a complete unknown about how much a settlement is going to cost, how much a judge is going to award, how much a jury is going to award. So you are really rolling the dice. You're really gambling when you're self-insuring liability. So we always tell people that if you're going to self-insure anything, self-insure a property, like an actual physical asset, and put that savings towards increasing liability because that's the complete unknown.
Julie, these jury awards are becoming astronomical, right?
No.
And so
Yes.
as a family, you got to protect those assets because for the most part, the cost per million on a liability policy is fairly affordable, right?
It
So,
is.
we're always going to recommend higher liability limits, but more importantly, it's the defense cost as well that can also skyrocket, especially if something's litigated. So, if you can get a policy where defense limits are included into the policy, that's always best. I think some insurance carriers, especially on the non-admitted side, right? They may exclude defense costs. They may exclude, libel. They
Libel and
may
slander.
exclude slander, right? So there's a lot of things that we are starting to see an exclusion in a liability policy. You can still get it, but it may be a little watered down versus what you're able to get in the admitted market.
Well, I just want to say thank you. We have so many of these conversations offline.
We do.
We
This is just another conversation we have on a daily basis, Julie.
I
This really is.
know.
This is what we're discussing off screen, with our clients, with each other, constantly strategizing, what's the market to bear. And let me tell you that the market is moving at a very fast pace. A year ago, we didn't think we would have any options for insurance here in the state of California after one of the worst wildfires ever. We now
Yep.
have several options, several carriers that are willing to take a look and provide policies. Or before, again, a year ago, we did not have that. So yeah.
All right. Well, thank you for joining us today. We appreciate your viewing. And as always, stay safe and stay protected.